So this whole GLB, it just facilitated the movement. Some people think, well, GLB started this whole convergence. It just collapsed because of it. The trend itself has been going on for quite some time. So if you observe this, and the Tower Group wrote a really nice paper on this topic, they said while securities and investment firms are asset managers, banks are the only possible liability managers. For this reason, there isn't a true liability manager today, all right? And we'll talk about why we use liability management versus mortgage planning, but the mortgage is really the ultimate liability management tool. And most of you guys, by being here, know that. You understand the power of the mortgage, the cost of borrowing, the tax efficiency. Fast forward to 2004, you've got Convergence starting to be personified in the famous Wall Street Journal article by Alan Greenspan, where he started asking about the way people borrow. Do they understand, okay, fixed and long-term mortgages? They understand how much they spend over their lifetime paying for risk that they don't need to pay for, getting a 30-year fixed mortgage and moving every 4.5 to 5 years. Do they understand that they could have saved tens of thousands of dollars in many situations by having adjustable rate mortgages? American consumers must learn to be willing to manage their risk. So again, the convergence is just continuing to happen. And then many of you are familiar with the August 2006 Whitepaper that was commissioned by the Chicago Federal Reserve to study the way people borrow. And here again, Greenspan said we've got to figure out, Social Security is not going to happen. How do we help people build wealth in the U.S.? And he felt like one of the biggest mistakes that they were making was they don't understand how to borrow. So they had this paper done. 38% of Americans are prepaying instead of investing. What they said in this paper was the wrong choice. Okay? 46.1% of Americans now prepay their mortgage by an average of $31.40 per year, a little less than $300 per month. The aggregate cost in lost savings is $1.5 billion a year. That's the annual lost savings by just this one mistake. And having access to better financial information was considered to be one of the key criteria in whether people made the correct decision or not. So again, I propose that you more and more, okay, are in the financial education business. That's what you're going to be rewarded for, and that's what your clients really want from you. The wealth in America has been shifting along the same timeline. From 2001 to 2004, if you had a stock portfolio, it lost about 34%, while during that same time period, your house value increased about 22%. Now, fast forward a few more years, the stocks have recovered most of their losses, but what's happened? We've continued to see real estate go up. Almost 42% growth nationally as an average during this time period. But what's amazing is between 1999 and 2006, house values in the U.S., just primary residences, increased from $10.4 trillion in aggregate value to $20.6 trillion, almost 100% growth. So there's a huge shift in wealth. Now, what you need to understand when you're thinking about financial advisors, they tend to stay away from real estate and the wealth associated with it because it crosses their suitability threshold into the world of eligibility, which they don't understand. Financial advisors don't like looking stupid to a client who pays them a whole lot of money to be smart. So there's a lot of resistance to want to go there, and that's where they're going to be relying more and more on people like you. So we go to 11/2008, and we ask ourselves, this market is converging. It's whipped one way on the asset side, and now it's whipped back the other way, and it's seeking balance. So 11/2008, the market, wait for it, is always right. So here's my first 1 degree for you. I can tell you that from talking to a lot of people in this space right now, there's a lot of questioning about what's going to happen to this and what's going to happen to that. If I give you 1 degree as a takeaway today, if you'll just buy into this concept, the market is always right, okay? You and I will be right occasionally, but the market is always right. Forget about it, focus on it, learn from it, and just do what it is that you do so well. There's a great Mary Chapin Carpenter song. Some of you are familiar with it. It's called The Bug. And the lyrics are, sometimes you're the windshield, and sometimes you're the bug. All right? So that's sort of what's happening right now. There are a lot of people out there feeling like the windshield, and there are a lot of people feeling like the bug, okay? But that could have been the name of our talk today. It sort of embodies a lot of different trends that are going on. So we have to talk about what is mortgage planning? What is it? I would tell you it's not about a product sales strategy. We went there. We went there in 1991, okay, and tried to use it as a product sales strategy. Can you sell product using it? Absolutely. But that's not what it's about. It's not a single product. It's not interest only, neg am, and invest the difference. That's a concept or strategy, but that's not what mortgage planning is about. It's not about a single person. In most cases, it's about a collective. It's not for everyone. A lot of people, including you, may be very happy doing what you were doing, and you don't need to learn this stuff if you don't want to learn it, okay? But what I will tell you is it's definitely about you, all right? If you don't master this for your own benefit, then you're really missing out, because that's the real gift here. When we as loan officers started looking at the financial planning concepts and calling on financial advisors, we couldn't help but be rubbed off on. We learned how to manage our money. We learned how to manage our debt in a way that we didn't think we would even begin to get to. And as we did that, we realized the power of this, because when we started living it, when we started incorporating these strategies into our lives, it was easy for our loan officers and for the people that we work with to integrate it into their clients' lives. So at a minimum, use this mortgage planning movement and this convergence around the balance sheet to create some wonderful wealth for yourself. So I'm going to shift now to liability management for mortgage planning, because in my mind, that's a better terminology for what this is all about, managing the liabilities of your client. Financial advisors manage assets, loan officers can manage liabilities. And if I had to define it, it's pretty simple. It's just understanding the financial impact that borrowing decisions have on wealth creation. Because it's true, everything is pretty well financed, okay? We're going to talk about borrowing versus investing, but liability management, understanding the financial impact that borrowing decisions have on wealth, especially over time. When you're in a financial planning world, it's very hard to get information from your client until there's a trust level that's built. And people are very short-term. As we say in some of our classes, people live a life of cash flow. They live day to day. Their confidence is tied to their cash flow. The cool thing about financial planning from a liability management standpoint was everything was tracking against 20 years or 30 years. I mean, you're not doing 3-year mortgages, right? You're doing 15-year mortgages, 30-year mortgages, 50-year mortgages now. So we can always compare the impact of these decisions over 30 or 40 or 50 years to help people see the financial impact that these decisions were going to have. So this was fun. This was a fun one that we used to show a client. So I'll share it with you just to kind of get you thinking. This could be a 1 degree for you. Rent payment, $1,500 a month. Over 30 years, it's about $500,000. If they could buy the same house and have approximately the same house payment over 30 years, they'd still spend about $500,000, okay? Now, this is North Carolina, all right, in my example. I know you can't get a whole lot out here for $225,000. If the house appreciated 4% annually for 30 years, it's worth about $500,000. A lot of financial advisors will tell you that real estate doesn't build wealth. Owning a home is not about building wealth. It's about preserving wealth. You understand? Because the difference between renting and owning a home over time is if the home appreciates, you can pretty much live there for free most of your life. If it appreciates over time, in many cases, that's a pretty good deal. It's a lot better than renting. But we have to ask the question, if I could have lived with my parents for 30 years, okay, what would the $1,500 a month, just earning 8% in a simple sort of a 401k type account, grow to? And the answer is $2.2 million. So where's the $1.68 million? Because the $1,500 a month that you're spending on the housing has an opportunity cost. It could have done something else. And while the house is going to appreciate at 4% either way, $1,500 a month over 30 years is $1.6 million. Well, if you look at over 40% of Americans age 30 now own a home, and their mortality for home ownership is over 60 years, take that same example, rent $1,500, normalized over 30 years is $1 million, house payment's $1 million. That same $225,000 house would be worth about $1.3 million. In other words, you kind of got to live there for free over that 30 years. But take $1,500 a month over 60 years, and what happens? It's $26.8 million. So if your house isn't worth $27 million when you retire, you've made a financial miscalculation.